Look, Steve is given one view. I take the other view. I think today's jobs number was an anomaly. In fact, the 10-year yield is now up 10 bips after really trading down in knee-jerk. We've seen these kind of aberrational jobs reports before. My focus is on wages, which are up 0.7 versus being down 0.1. You have to average these employment reports on a 3-month basis, not look at it at a one shot and say, that's it. Futures were up, and they were up nicely before the market opened, before the jobs number came out. So look, if you're basing your investment strategy on today's jobs report, you're making the wrong move. We've come through earnings. We saw earnings were phenomenal. We saw virtually every economic report except this one, again, except for wages were higher, showing that the economy is booming. So what this is giving you, and what I took the opportunity to do, is add to cyclical exposure on this. So it's lifting tech today a little bit, but don't base it on a one-day referendum on the jobs report. Your strategy that you had going into today was the right strategy. It shouldn't change.
Well,
period, end of story.
Shannon, the strategy for many coming in was get out of high-growth tech and go into the recovery and reopening stocks, because they're the ones that are going to benefit from a cyclical boom unlike any that we have ever seen in our collective lifetimes.
Right. And so perhaps some of that enthusiasm has been deflated a bit by this jobs number. I agree. I think the story is somewhere in between the two Steves here. I think that there are portions of the economic recovery on the employment side that will be choppy. I do think that there is room in your portfolio for both some of these reopening trades as well as some of the names that have worked historically. I think the most important thing to note here from an economic standpoint is who's running the show. President Biden and Janet Yellen had a front row view of the lack of fiscal stimulus in 2010 and 2011 that created a very long tail for the growth recovery after the financial crisis. Shifting ahead, we should be talking about not only a Fed overshoot, but also a fiscal overshoot. And I think that there's a lot of support for that. I think that we're going to continue to see some missteps and some steps back in economic data. But overall, this is going to ease some of the pressure we've seen, Scott, over the last couple of weeks about the sell in May and go away on this strong economic data. We're still going to see some consolidation and weakness, in my view, on the back half of May. But I think that this takes a little bit of this rotational wind out of the sail.
When you say things like fiscal overshoot and Fed overshoot, I think, Pete, of, asset bubbles being inflated, perhaps too much so, before we realize exactly this monster that we've created by both of these policies being full throttle, pedal to the metal for such a long period of time.
Yeah, and Scott, I think the important part here is that we're talking about inflation, and everybody's touched on this, but the wage inflation as well. And I mean, the reality is this, that you can go out anywhere in the country right now, and it's very, very difficult for everybody to be able to be in the employment area right now because of the fact that they're still in this mode of maybe there's still some fear, but also the idea that, hey, look, they're making money at home. Are we giving those incentives to stay at home? I mean, there's a lot of great questions here, but I'm with Steve in terms of this is one number, and I don't think you can take everything away from just this one single number right now. I think you got to see the smoothing process of what's exactly going on. But one of the things that we absolutely know is we have seen this shift from a lot of these high multiple names, and you can go down the entire list and you can see where they were, Scott, even call it 2 months ago. But let's go back to February, and you can look at almost every one of these names that we refer to as the high multiple or maybe even no multiple stocks, and those stocks have come down dramatically. I don't think that's over. I think we're going to see more and more of that, and we're starting to see the fundamentals becoming much more important in this market. And I'm not just talking about financials or industrials or energy or materials. I'm even talking within tech, and we're seeing it within tech right now, where you're seeing those that have great fundamentals, they've got great balance sheets, and they still do have growth. Those are the names that are outperforming right now, and those are the names that I think will continue to outperform in the next couple of months.